The Great Depression was the worst economic crisis in modern history. The U.S. economy shrank by nearly 90%. 1 in every 4 Americans was out of work, and more than a third of all banks in the country collapsed. But the Depression wasn't just contained to the U.S. It changed the course of history on a global scale, and even today, we're still feeling its effects. So let's break down what really happened during the Great Depression, what caused it, and how it changed the world. Welcome to Alux. Now, before we can talk about the Great Depression, we need to understand the world that came before it. So let's go back to the early 1920s. World War I had just ended, and it forced countries to industrialize, to build factories, improve logistics, and mass-produce weapons and supplies. When the fighting stopped, those factories turned their attention toward consumer goods. The assembly line, pioneered by Henry Ford with the Model T, had transformed production. Suddenly, companies could make more products, faster and cheaper than ever before. Now, at the time, the United Kingdom was still the world's leading economic power, promoting free trade across its global empire. Less developed countries largely supplied food and raw materials, while industrial countries like Britain, Germany, and the United States turned those materials into finished products and sold them around the world. It was the beginning of modern globalization. And in this new economy, no country thrived quite like the United States. Unlike Europe, the US had emerged from World War I with its cities intact and its industries booming. Women were in the workplace in larger numbers than ever before, and soldiers were returning home. So factories were returning to full capacity, jobs were plentiful, and optimism was everywhere. With the rise of radio, advertising, and mass production, America entered the age of consumerism, and things seemed perfect on the surface. But they weren't. As the Roaring '20s went on, banks started lending more and more money, not just to businesses, but to ordinary people. Most couldn't afford to pay for expensive products like cars, refrigerators, and washing machines up front, so banks filled that gap with loans. Now, at first, it worked beautifully. People bought more, businesses grew, and the money kept circulating throughout the economy. Because of this, the American stock market was booming. So a bunch of ordinary people who had never owned stocks before started investing their savings. Eventually, people ran out of savings, but since the market just kept climbing, many of them decided to borrow money to keep investing, and banks were more than happy to help. They began lending money specifically for stock speculation. Now, again, the logic was simple. Borrow cash, buy a stock, wait for it to rise, sell it, repay the loan, and pocket the difference. As long as prices kept rising, everyone made money. And it did work for a while. From 1921 to 1929, U.S. stock prices did nothing but go up. The Dow Jones did a 6x, for crying out loud. But people were forgetting a painful reality. Just because stocks are hot doesn't mean the economy is, and at the time, the cracks were already starting to show. So underneath all of the optimism in Wall Street, the economy was actually not doing so great. Even by the mid-1920s, consumer demand, which was essentially the backbone of the economy, had started slowing down. Turns out people only need so many toasters. Across the ocean, Europe was still recovering from World War I, and I couldn't afford to import as many American goods. It started slowly, but US factories were producing more stuff than people actually wanted to buy. Supply was outpacing demand, but the stock market had become completely detached from reality. By 1929, around 40% of all US consumer debt wasn't being used to buy homes or start businesses. It was being used to buy stocks. It was a bubble built on borrowed money, and when people finally began to doubt that prices would keep rising, that is when everything started to fall apart. And all right, let's just pause here for a moment, because look, if you're watching this video right now, we're willing to bet you're the kind of person who actually cares about wealth, success, and building a better life for yourself, right? Here at Alux, that's exactly what we're all about. It's why we built the Alux app, to teach you about wealth creation and help you become the ultimate version of you. Inside the app, you'll find daily lessons to help you level up your money, intelligence, fitness, even your confidence in relationships. You'll also get access to full courses from industry experts on topics like entrepreneurship, personal branding, and even building up your self-esteem. The kind of skills that actually move the needle forward in real life. Right now, if you scan the QR code on screen or click the top link in the description of this video, you can download the app and get 25% off your yearly plan. Because look, okay, markets can crash or spike on any day, but your education will always be with you, my friend, so invest in yourself. That's how you're going to become who you're actually meant to be. All right, with that said, let's get back to the video. So on October 24th, 1929, panic hit Wall Street. In a single day, the market dropped 11%, an all-time record back then. The day became known as Black Thursday. The following week, on October 29th, now known as Black Tuesday, prices collapsed another 12%. Within just a few weeks, the stock market had lost nearly 40% of its value, and millions of Americans lost their savings. For those who had borrowed money to invest, it was even worse. Their investments were now worthless, but they still had to repay their loans. The bank that had loaned them the money now faced massive losses. Over the next few years, the stock market continued sliding down until it finally bottomed out in 1932, down almost 90% from its peak. Now, something that's important to note here is that a lot of people think the stock market crash of 1929 was the Great Depression itself. But in reality, it was only the beginning. The true disaster came when financial panic spread into the real economy. So, the stock market crash was just the first domino to fall, and once it did, it set off a vicious chain reaction across the entire economy. The first thing that happened was simple. People stopped spending money. Consumer spending was the backbone of the American economy at the time. But after the crash, many had lost their savings or were trying to repay loans. So instead of buying things, they used the money they had to save or pay off their debt. When spending drops, businesses earn less, and they either have to pay people less or lay them off. And if that's not enough, they go bankrupt. That meant unemployment rose, which means even fewer people could afford to spend, which meant the cycle just kept on repeating, and the less people spent, the worse things got. As the months went by, people and businesses started defaulting on their debt. And when borrowers go broke, lenders suffer too, especially the banks. Now, the thing about the banks back then is that there was no JP Morgan or Bank of America holding trillions of dollars in assets. In the 1930s, the US had thousands of small local banks, and when one of their customers went bankrupt, that loss hit the bank hard. So when banks started going bankrupt, panic spread very fast. Everyone rushed to withdraw their money before their bank failed. These were called bank runs. At first, it happened at small local banks since they were the most at risk, but soon the panic spread to bigger ones too. Even healthy banks began collapsing, not because they were mismanaged, but because everyone was too scared to leave their money inside. By the time it was over, about 1/3 of all banks in the US had failed. And back then, when banks failed, their customers lost everything. To make things even worse, the people who did manage to pull their money out in time weren't putting it into the banks. They were keeping it at home. That meant that banks had no money left to lend out. And when banks stop lending, businesses can't get loans to grow, and people can't get loans to buy homes or start companies. In other words, the economy's fuel, money, just stopped moving. Now, at the same time, factories across the country kept producing goods because they had to. Factories are expensive. You can't operate one by selling 10 refrigerators a month. You need to sell thousands. The problem, obviously, was that people weren't buying, so supply was way up and demand was way down. And look, okay, ask any economist in the world what that means, and they will say one word: deflation. Now, deflation is the economic term for prices in an economy going down. In this case, it was happening because businesses wanted to get rid of their stockpiles. And you know, at first glance, deflation sounds kind of like a good thing. Things are becoming cheaper and people can afford stuff now, right? Well, in reality, deflation is actually one of the worst things that could happen to an economy. Think of it like this. If a car costs $50,000 today, but only $40,000 3 months from now, when are you going to buy it? Well, obviously, you're going to want to save yourself 10 grand. But take an entire economy of people thinking that way, and what do you get? Less consumer spending, the thing that is causing the Depression in the first place. So basically, the Great Depression was a vicious cycle of many interconnected factors making each other worse. Falling prices led to less spending led to more bankruptcies meant fewer jobs, and fewer jobs meant even less spending. And just like that, the US was in a full-blown crisis. But just to put this into perspective, it's worth asking, why do we call it the Great Depression? Well, technically, when an economy shrinks for 2 quarters in a row, 6 months of negative growth, it's called a recession. When a recession gets really bad, it earns a new name, a depression. Now, this one was so severe that people simply started calling it the Great Depression. The official economic contraction lasted from August 1929 until March 1933, 43 months later when the stock market finally hit rock bottom. That makes it the longest and deepest recession in modern US history. Now, technically that marked the end of the recession because the economy stopped shrinking and began to grow again. But that did not mean that things were good. The stock market was down 90% from its peak, and at one point, unemployment reached 24.9%. Just think about that. 1 out of every 4 Americans with no way to provide for themselves or their families. Living in that kind of economy was devastating, and the recovery was painfully slow. The economy was growing again, yes, but it was growing from a completely shattered base. Poverty, homelessness, and crime were rampant, and breadlines had become a daily reality. The truth is, the pain of the Great Depression didn't really end until 1939 when World War II began and factories started running again to supply the war effort. And it took until 1952, 23 years after the crash, for stocks to finally climb back above where they had been in 1929. That is how devastating this period really was. And in the middle of all of this, the United States had to respond somehow. But the way the government handled this, especially at the start, didn't just fail to fix the problem, it actually made things worse. You see, by this point, the US economy was a mess. Businesses were collapsing, banks were failing, and people were terrified to spend money. The government somehow had to get people buying things again, especially American-made goods. More spending would mean more business activity, more jobs, and eventually higher prices to fight off deflation. So one of the first things they tried was to raise import taxes on more than 20,000 foreign goods by about 20%, hoping people would buy local instead. And for those of you wondering, yep, that's a tariff, and yep, it completely backfired. Almost immediately, 25 other countries responded by raising their own tariffs on US goods. So the few American businesses that were still exporting suddenly lost their foreign customers. More factories shut down, and even more people lost their jobs. In fact, global trade, which had once been booming, collapsed by about 66%. So that definitely didn't help. The government's next goal was to stop prices from falling further. Now, at the time, the US dollar was tied to the gold standard, which meant the government could only print as much money as it had in gold to back it up. But that made it almost impossible to inject new money into the economy. So in 1933, President Franklin D. Roosevelt took the US off the gold standard for just a few years. This gave the government the freedom to print more money, and with it, they started lending to banks, which could then lend to people and businesses again. They also began funding large public works projects, building roads, parks, bridges, and schools, all of which created jobs and pumped cash directly into the economy. Roosevelt also raised taxes on the wealthy to fund social programs for the unemployed, the elderly, and the disabled. To fix the banking crisis, Roosevelt's administration rolled out a wave of reforms, all part of what became known as the New Deal. Banks were required to hold a minimum amount of money in reserve so they couldn't run out of cash overnight. They declared bank holidays, temporarily closing banks so people couldn't withdraw all of their money at once. And before reopening, every bank had to be inspected and certified as stable. Now, behind the scenes, those inspections were sometimes little more than just some paperwork, but the government's stamp of approval restored public confidence, and people started depositing their money again instead of hiding it under the mattress. With more deposits, banks could lend again, which meant more money circulating through the economy. To make things even safer, the government introduced FDIC insurance, which guaranteed that if a bank failed, people would still get their money back up to a certain limit. And that wasn't all, okay? The New Deal also brought in Social Security, the Securities and Exchange Commission, unemployment insurance, minimum wage laws, and overtime pay. Now, these changes, they didn't magically fix everything overnight or anything. Unemployment stayed painfully high for most of the 1930s, and it took years for the economy to stabilize and for prices to start rising again, which, after years of deflation, was actually a good thing. But these reforms laid the foundation for the modern financial system every American is a part of today, and for the slow, steady recovery that would follow. But, before we forget, the Great Depression wasn't just an American problem, remember? As world trade collapsed by about 66%, entire economies that relied on exports were suddenly cut off from their income. Prices for things like coffee, sugar, cotton, and materials fell through the floor, and places like Latin America, Africa, and Southeast Asia, which depended on selling raw materials or agricultural goods, had their economies crippled almost overnight. Industrial nations were hit just as hard, but in different ways. In Europe, unemployment soared as factory after factory shut down. France entered years of stagnation. In Britain, unemployment climbed past 20%, and in Germany, their situation was catastrophic. The country was already hanging on by a thread after World War I, but the Depression gave rise to extremist political movements, and we all know what comes next. Similarly, Japan's exports collapsed, so it militarized and launched invasions to secure its own resources, which played a huge role in World War II. So, as you can see, the Great Depression didn't just reshape economies, it reshaped history in a very real way. But what was learned through all of this? Because out of all the devastation came some important lessons. We learned that a little bit of inflation is actually a good thing, that during crises, governments have a vital role to play in steering the economy, and that government spending could be used to stabilize demand and pull economies out of a downturn. And that idea became foundational for modern economic policy in much of the developed world. By the end of the Depression, and especially after World War II, most major economies had restructured their banking systems, added social safety nets, and accepted that government intervention was a necessary part of keeping capitalism alive. Maybe most importantly, the Depression taught people that recessions and crashes aren't just numbers on a chart. They're human stories. Behind every percentage point of unemployment, there are millions of lives turned upside down. So, the Great Depression wasn't just an economic crisis. It was a turning point in how we understand money, markets, government, and people. Alright, Aluxer, to wrap this up, make sure you subscribe if you enjoyed this video, because over the next few weeks we're going to be covering the 5 biggest economic crises after the Great Depression. If you want to learn the biggest economic problems that we're facing today, well, click the thumbnail on the screen and watch the next video. Hopefully they don't send us into the next depression, right? Anyway, thanks for joining us today, Aluxer. We'll see you back here next time. Until then, take care, my friend.